Hello, this is the first in the series for Unit 2 for GCSE AQA Business Studies, and we're looking at LTDs and PLCs, and specifically the advantages and disadvantages of changing from an LTD, a private limited company, and becoming a public limited company. So some of this is a bit of a crossover from the legal structure video that I did for Unit 1, but that was mainly focused on sole traders, partnerships, and LTDs. Remember, this is the overview of the legal structure in the UK. We've got the public sector, which is run by the government, and we've got the private sector over here. And we were mainly looking at sole traders, partnerships, and LTDs in the first video, although I did do some comparisons with PLC there, so it's worth giving that a watch as well. But here are some key terms for this video. We're going to be talking a lot about liability. So debts or liabilities are money owed by the business. Responsibilities. So limited liability, which both LTDs and PLCs have, are where the owners can only lose what they've invested into the business. So their responsibility is limited to the amount that they've invested, whereas unlimited liabilities was what sole traders and partnerships had, and this is where the owner is fully responsible for the debts of the business. So lots of students, understandably, because the names sound quite similar, we've got two of the words in PLC and LTD, which are the same, which is the limited company part. And students often get confused between the two. But if you remember, the difference between an LTD and a PLC is that only friends and family can buy shares. So the shares are not floated on a stock market in an LTD. We've got the word limited in there, which means that they both have limited liability, and the word company means that they're owned by shareholders. Whereas with a PLC, we've got anybody who can buy shares in this business because they're going to buy it through a stock market. Limited again, so it means limited liability, and company owned by shareholders. So they're very similar in a lot of ways, but it's this share ownership, how you can buy the shares, that's different. So with both of them, we say that they're incorporated. We know that they're incorporated because they have this idea of limited liability. And what that means is that firstly, the business exists legally. It's a bit like a person in a way. And that means that there's a separation here. I've got a picture of a person meant to be representing the shareholder or the entrepreneur. And we've got a personal asset of theirs, a house here. And I've put a dotted line there to represent that there's legally a difference between the business and the person. So even if this person owns some of the business in the form of shares, or runs the business, maybe they're a director, they are legally separate from that business. So the business can have legal action taken against them, maybe if they haven't paid all of their debts, maybe if they've done something, they've broken some health and safety laws, but the person isn't personally liable unless they've not followed the company rules. Whereas remember, with sole traders and partnerships, they didn't have that. They had unlimited liability, so there's no legal difference between the business and the person. So here's an overview. Went through this with the last presentation as well, so you can catch up on that. I'll go through it a little bit more quickly in this one. So an LTD, they have many owners compared to a sole trader and partnership, and many owners for a PLC. You tend to find that there are more people who have a stake in the business with a PLC just because of the way the shares are sold. The owners for both of them are called shareholders, so we're going to have way more shareholders usually for a PLC than an LTD. They both have limited liability, so limited responsibility, and both of them will have the business run by directors. The main decisions on the day-to-day kind of strategy of the business will be determined by the directors. Now, in an LTD, it's very likely that a lot of these directors will be major shareholders in the business. With a PLC, it's likely that the director will be a shareholder, or the chief the CEO, the chief executive officer. Sometimes we call that in kind of America. You probably hear that word or term CEO a lot more commonly now than managing director, which is the more British term for it. So they're likely to have, when they've been employed, been given shares. They're likely to have been rewarded with shares in the business, maybe for good performance. So they're likely to be a shareholder, but they don't need to be really. I mean, they don't need to be a shareholder to run the company if there's an LTD as well, but it's more likely that these directors have probably been with the business for a long time, they've seen it grow, they're more likely to hold a bigger stake in the business. If you're a recently appointed CEO or managing director, you might not have a huge stake in the business in terms of the amount of shares that you own. Okay, now that becomes significant a bit later on, so I'll come back to that in a second. Here, sorry, I made a bit of a mistake. I'm going to cross that out. I didn't notice that there. It's not the difference between LTDs and PLCs. So the benefits of the LTDs, obviously we're going to have limited liability. In terms of comparing it to a partnership or a sole trader, it tends to be more trusted by businesses. Now the reason for this is to become an LTD, you have to go through lots of legal procedures. So you have to register with Companies House, and you have to meet regulations, and you have to have your you have to publish your financial records like your balance sheet, your income statement or profit and loss. And so therefore, because you have to go through all these legal requirements, you tend to be more trusted by customers, more trusted by banks, more trusted by suppliers as well. And we also know that you can sell shares to raise money for your business. So that's what a lot of the businesses, a lot of the people, the entrepreneurs that go onto the program Dragon's Den are doing. They're LTDs and they're selling a stake in their business. However, as I did mention before, you do have to publish accounts. So your customers, your competitors are going to be able to see those things as well, and they might be able to have some insight into your business that you didn't necessarily want them to have. And remember, when we look at liquidity ratios such as current ratios and the acid test ratio, also known as the quick ratio, that can tell banks or lenders or suppliers whether they've got a worrying liquidity situation in terms of whether they're high risk for paying off debts or paying off credit or things like that. So that could make it less likely that a bank or a bank's willing to lend to you, or a supplier's willing to give you credit. In terms of PLCs, the benefits, again, they have limited liability. So both sides have limited liability, but you can still mention it in the 9-mark question, say that they retain their limited liability. So that's demonstrating to the examiner that you know the difference between the LTD PLCs and the unlimited ones, the sole traders and partnerships, those are. They tend to be a little bit more trusted. Now, they are trusted by businesses, both sides, I've put them, but they might be more trusted by businesses and suppliers and banks. And one of the reasons for this is not only do they have to go through tight regulations to become a PLC, but you also, to sell your shares on the stock market, you have to go through what we call this process of due diligence, which is just checking and making sure that this is a legitimate company, because the stock markets are actually businesses themselves, and they don't want to let anybody sell shares in dodgy businesses. So there's an even more serious checking process that goes on. So because any business that is a PLC has gone through both of these kind of checking processes, the things that LTDs have to do, but also the things that they have to do to be sold on a stock market, then it tends to mean that they're more trusted by other businesses, lenders. They might have a lower interest rate because banks trust them more. They might have more customers because they're more recognized, and people feel safer doing business with them. They can also, we know that one of the main advantages from sources of finance is you can raise large sums of money by selling shares on a stock market. So these are going to be more significant amounts of money that you can raise than an LTD is going to be able to raise through selling shares to friends and family, because that's going to be a very limited market that you're going to be able to sell them to. However, have to publish accounts as well. They're easier to get hold of, these PLC accounts. If you go onto Google Finance, there's all of the accounts of PLCs on there, and all of the other companies. In America, they're incorporated. For PLC is like a British term for public limited companies, but in America they call them Inc. So you can find out loads of the accounts of all the incorporated businesses that are traded on the stock markets. It's really expensive to set up because you have to go through that due diligence process, and it's very you're going to have to get financial advisors in who are very expensive. You have to meet lots of conditions. You can also, it depends how much of your business you're willing to put up for sale. So say you've got kind of a group of entrepreneurs that have set up the business, and then they decide they're going to float it on a stock market. They can't just say, right, we're going to sell 50% of the shares, and they retain all of the control, because when you're selling shares, you're giving away voting rights as well. So you can lose some control of your business depending on how much of the business, what percentage of the business you're willing to sell on the stock market. And we also get this divorce of ownership and control. Now, you can get this on this side as well, this divorce of ownership and control, but it's less likely. So I think I've got, here we go. Here's my slide with divorce of ownership and control. So the shareholders aren't necessarily the people that are running the business. They might not be. Now, in LTDs, it's more likely that the shareholders are managers, and even if there are some shareholders that aren't the managers, they're probably relatives of the managers who are also shareholders as well. So they're not likely to do anything that's going to kind of rock the boat and upset things, and their interests are probably going to be aligned. Whereas with PLCs, you're more likely to get shareholders who are not running the business and making kind of the strategical decisions. They just own a share. They might not even vote at the AGM, which is the annual general meeting of the business. So what you can get is these managers that are motivated by revenue because they want to be working for a very prestigious business, and revenues and the turnover is a good way to kind of measure the size of a business, and they're motivated very much by their bonuses, and then the shareholders are motivated by the share value. They want their shares to be worth as much as possible, and maybe dividends as well. And they don't necessarily align with each other. So this can be a big problem with these kind of PLCs, when the managers are running the day-to-day operations, but they don't necessarily have the same interests as the owners. So that's what that phrase means, the divorce of ownership and control. Here's an example of a business that turned recently, I think it was 2012. They turned from an LTD, it would have been the American version of LTD, into a PLC, which the American version was Inc., as I said before, and they floated on the NASDAQ, I think it's pronounced actually, which is an American stock exchange, and they overnight on the American stock exchange were made very, very rich people. There's Mark Zuckerberg at the front there, and that's a business that obviously has changed from LTD to PLC, and that made Mark Zuckerberg very, very rich, as along with all the founding members. But if you watch the film The Social Network, you'll see that Eduardo something, I can't remember his surname, but he was one of the friends that also set up Facebook, and his shares were diluted down, and this is the basis of the film, The Social Network. But that's a really good example of how when firms turn from LTDs to PLCs, they can lose some of that control and ownership. They're diluting down their ownership of the business. But it's actually a really interesting story to see the flotation of Facebook and what happened, and especially what has happened to the share price as well, just after flotation and a few years after it as well. Obviously, when they sell, I think they sold about 25% of a stake in Facebook. When they sell it, that's it. That's, they get that 25% represented to the business. But now the share price actually is a lot higher. It's roughly double. I'm saying this in 2016. I don't know what's going to happen in the future, but it's roughly double what it was when it was first floated on the stock market. But Mark Zuckerberg himself isn't getting that money, because he got that in 2012 when he sold the 25%. So what I'm saying is you can only sell it once and then it's sold, and anyone that's kind of buying and selling it, they're getting the benefit of that share at that point. Okay, so those are the advantages and disadvantages of a public limited company becoming a private limited, a private limited company becoming a public limited company, and it's these things that you have to have a good overview of.